The Pentagon is not just handing Palantir another defense contract. That is the easy headline. But it is not the real story. The real story is that Washington may be pulling Palantir deeper into the nervous system of American defense. That is why this moment is so important for people, and that is also why the stock is so risky right now. Because when Wall Street looks at a company and says, this is no longer just software, this is national security infrastructure, the upside story gets much bigger. But the tolerance for disappointment gets much smaller. The latest clue is the Maven Smart System. The Department of Defense has reportedly requested about $2.3 billion in funding tied to Palantir's Maven Smart System, a military AI platform connected to intelligence, targeting, and decision support. The key point is that this is not about a random software tool sitting on the edge of the Pentagon budget. It is about a system that may become part of the core battle management layer. So, when someone says Palantir just got another government deal, I think that is the wrong read. This is not only about revenue, it is about dependency. It is about whether the US military is starting to build more of its AI decision workflow around Palantir. And once that happens, the story becomes much bigger than one contract. It becomes a lock-in story. It becomes a budget story. It becomes a valuation story. And for investors, that is exactly where the opportunity and the danger meet. The important phrase here is program of record. It sounds boring. It sounds like government language that nobody wants to read. But in defense spending, those words matter. Reuters reported that Palantir's Maven AI system is set to become an official program of record, which would support long-term funding and broader use across the US military. Reuters also reported that the decision is expected to take effect by the end of the current fiscal year, which ends in September. That changes the whole discussion. Before, Maven could be seen as an important tool. Now, it looks more like an official layer. That is a different category. Because when a system becomes official, it is no longer treated like a nice experiment. It becomes something branches plan around. It becomes something budgets are written around. It becomes something people are trained on. It becomes something that can spread from one command to another command. And that is exactly what investors mean when they talk about a moat. Not a moat in the simple software sense. Not a moat because the interface looks nice. Not a moat because the sales team is aggressive. A real moat comes when removing the product becomes painful. And in defense, painful can mean slow, expensive, political, operationally risky, and almost impossible to do quickly. That is why Maven matters. The $2.3 billion headline gets attention. But the real prize is not the number. The real prize is position. If Palantir becomes the layer that helps organize military data, then the company is not just selling software to the Pentagon. It is becoming part of how the Pentagon operates. This is where Palantir stops looking like a normal SaaS company. A normal enterprise software customer can test a product, dislike it, and switch. It may be annoying, it may take months, it may involve consultants, but it is still possible. Defense systems do not work that way. Once a platform is connected to classified data, command workflows, permission systems, mission planning, intelligence feeds, and battlefield operations, switching is no longer just a technology choice. It becomes an organizational surgery. You are not changing one app. You are changing how data flows. You are changing who has access. You are changing which teams trust which dashboards. You are changing how decisions are made under pressure. That is why the market is starting to look at Palantir through a different lens. In the old view, Palantir was the company you called when government data was messy. Databases could not talk to each other. Legacy systems were stuck. Agencies needed visibility. Palantir came in, organized the chaos, and gave people a usable operating picture that was already valuable. But now the story is moving from cleanup to command. From data repair to decision infrastructure, from vendor to operating layer, and once a company moves into that position, the valuation conversation changes. A vendor gets paid for a contract. An operating layer gets priced like a strategic asset. That sounds bullish. But it also creates a problem. The more strategic the market thinks Palantir is, the more expensive the stock gets. And the more expensive the stock gets, the less room there is for normal mistakes. At a normal valuation, ordinary results are fine. At a premium valuation, ordinary results can be punished. Now we need to understand Maven. Because if you only hear the words military AI, you may picture a basic software contract that is too small. Project Maven began in 2017 as an effort to apply AI to military imagery, especially drone footage. Over time, it expanded into a much broader command and control platform. Reuters says Maven can analyze data from satellites, drones, radars, sensors, and intelligence reports. Then use AI to identify potential targets or threats. Reuters also noted that the program began as a drone imagery labeling project, and later grew into something with tens of thousands of users. So this is not just find the object in the video, it is closer to connect the battlefield, satellite images, drone feeds, radar, ground sensors, intelligence reports, operational maps, mission data. All of that can move into one environment where commanders are trying to see faster, decide faster, and act faster. That is why Maven is so important. It is not only a product, it is a window. It is a window into the modern battlefield. And if that window becomes the one the military uses every day, then Palantir is not just providing technology, it is shaping the workflow. That is the bull case. Palantir is not selling a dashboard, it is selling speed, it is selling coordination, it is selling a way to turn scattered information into action. In military terms, that matters. In stock market terms, that matters too, because investors do not pay huge multiples for simple tools. They pay huge multiples when they believe a company controls a critical layer. But the moment Palantir starts getting priced like critical infrastructure, the stock becomes harder to own. That may sound strange. Usually, investors want companies to become more important. They want sticky customers, they want long contracts, they want government budgets, they want switching costs. Palantir has all of that in the bull case, but the stock market does not give that away for free. It charges you up front. That is the problem. Palantir is not cheap. As of April 24, 2026, Stock Analysis listed Palantir with a trailing PE ratio of about 227, a forward PE ratio of about 108, a price-to-sales ratio above 76, and a forward price-to-sales ratio around 46. Finance charts showed a similar picture, with Palantir trading around 227 times trailing earnings and roughly 116 times forward earnings on April 24th. Different data providers can show slightly different numbers, but the message is the same. The market is already paying for a lot of greatness, not just good growth, not just good execution. Greatness. At this kind of valuation, investors are not only asking whether Palantir is real, they already know it is real. They are asking whether it can keep growing fast enough to justify a stock that already prices in a very powerful future. That is the key tension. Palantir may be one of the strongest AI software stories in the market, but a strong story can still become too expensive. And when a stock becomes too expensive, the risk is not only bad news, sometimes the risk is good news that is not good enough. That is where Michael Burry enters the story. Burry did not need a full research report, he only needed one line. He said Anthropic is eating Palantir's lunch. Business Insider reported that Burry argued Anthropic offers businesses an easier, cheaper, and more intuitive AI solution, and Palantir shares fell about 8% in the session after his comments. Business Insider also reported that Burry pointed to Anthropic's rapid growth and its traction with business customers. Now, whether you agree with Burry or not, you cannot ignore the pressure point. He is not saying Palantir has no business. He is saying the commercial AI profit pool may shift toward model companies and lighter tools. That is a different argument, and it is more serious, because Palantir's government business may be protected by security requirements, procurement complexity, and deep integration. But commercial buyers are different. A bank, a hospital system, a factory, a logistics company, a law firm, a media company. They may not need the full Palantir machine for every AI use case. Sometimes they need a coding assistant. Sometimes they need document search. Sometimes they need customer support automation. Sometimes they need an internal co-pilot. Sometimes they need a model that plugs into existing workflows fast. If Anthropic or OpenAI or Google can solve enough of those problems at a lower cost, then Palantir may still win the hardest use cases, but it may not capture every AI dollar, and for a stock price for explosive growth, that matters. The company does not have to lose, it only has to win less than expected. This is why the difference between a model and a platform matters. A model is the engine, a platform is the aircraft. That is not a perfect analogy, but it helps. In a commercial setting, the engine may be enough. A company can say, we want Claude, or we want ChatGPT, or we want Gemini. Then, they connect it to internal tools, build a workflow, and move quickly. That can be powerful. That can also be cheaper than a full enterprise deployment. But in defense, the platform matters more. The system needs security. It needs audit trails. It needs user permissions. It needs classified data handling. It needs reliability across ugly legacy systems. It needs to work inside an environment where the cost of failure is not just a bad customer experience. It can be a mission failure. That is why Palantir's defense moat is different from its commercial moat. In defense, Palantir is not competing only on model quality. It is competing on integration. It is competing on trust. It is competing on being embedded. It is competing on the ability to connect data sources that were never designed to work together. Reuters reported that one complication around Maven is its use of Anthropic's Claude because Anthropic had been deemed a supply chain risk by the Pentagon amid a dispute over AI safety guardrails. Reuters also reported that Palantir says humans remain responsible for selecting and approving targets. That detail cuts both ways. It shows that model companies can matter, but it also shows that the platform controlling the workflow may be harder to replace. The Anthropic story has only gotten more complicated. The Associated Press reported that Anthropic told a federal appeals court it cannot manipulate Claude once the tool is deployed in classified Pentagon networks. AP also reported that the dispute is tied to how AI can be used in fully autonomous weapons and potential surveillance, and that the Pentagon had canceled a $200 million contract with Anthropic after the disagreement. That gives investors two different messages at once. First, Anthropic is not some small model company on the side. It is powerful enough to be in the middle of serious Pentagon debates. Second, that same power creates political and operational complexity. In consumer AI, a model company can move fast. In enterprise AI, it can move fast. But in national security, speed is not enough. The government wants capability. It also wants control. It wants performance. It also wants compliance. It wants innovation. It also wants accountability. That is why Burry's argument is strong on the commercial side, but less clean on the defense side. In commercial AI, a model company can eat a lot of software spending. In defense AI, a model company may be important, but it still has to fit inside a larger command architecture. That is where Palantir has leverage. If Maven becomes the system that organizes data workflows, users, permissions, and decisions, then Palantir can swap models, add models, remove models, or layer models into the system. The model is important, but the platform decides how the model is used. That is the distinction the market needs to understand. And that is why the Palantir debate is not simple. Burry can be right about commercial pressure. The bulls can be right about defense lock-in. Both can be true at the same time. Now let's look at why the Burry warning hit so hard. Anthropic is not standing still. Reuters reported on April 24 that Alphabet plans to invest up to $40 billion in Anthropic, including an immediate $10 billion cash commitment at a $350 billion valuation, with another $30 billion tied to performance targets. Reuters also reported that Anthropic's annual revenue run rate had surpassed $30 billion in April, up from about $9 billion at the end of 2025. That is why investors are paying attention. This is no longer a small startup story. This is a frontier AI company attracting massive capital, massive demand, and massive strategic support. Anthropic also has traction in business spending data. Ramp's March AI Index said overall business AI adoption reached 47.6% of businesses in February, and that 24.4% of businesses on Ramp were using Anthropic. Ramp also said Anthropic was winning about 70% of head-to-head matchups against OpenAI among businesses purchasing AI services for the first time. That does not mean Anthropic replaces Palantir, but it does mean companies are getting comfortable buying AI directly from model providers. That is the real risk. The risk is not that Palantir disappears. The risk is that some customers choose lighter tools first. They may still call Palantir for the most complex work, but they may not call Palantir for every problem. And valuation is built on expectations. If investors expect Palantir to capture a massive share of enterprise AI spending, but model companies capture more of that spend directly, then the market has to adjust. Not because Palantir is weak, because the expected prize pool changes. This is where we need to separate the company from the stock. The company is strong. The stock is demanding. Those are not the same thing. Palantir's latest reported numbers are impressive. Its Q4 2025 release said revenue grew 70% year-over-year. U.S. commercial revenue grew 137%, and the company issued 2026 guidance for 61% revenue growth and at least 115% growth in U.S. commercial revenue. The investor presentation also showed Q1 2026 revenue guidance of about $1.532 billion to $1.536 billion, full year 2026 revenue guidance of about $7.182 billion to $7.198 billion, and adjusted free cash flow guidance of roughly $3.925 billion to $4.125 billion. Those numbers are not normal. For a large software company, that kind of growth is rare, and it explains why the bulls are so passionate. Palantir is not just promising AI revenue, it is showing AI revenue. It is not just saying enterprises are interested, it is reporting commercial acceleration. It is not just talking about government demand, it is getting deeper into government budgets. So the bear case cannot be lazy. You cannot just say, this is hype. There is real revenue. There is real cash flow. There is real government adoption. There is real commercial growth. The better bear case is different. The better bear case says, yes, this is a great company, but is it great enough for this price? That is the real fight. Great business versus extreme valuation. The government side keeps adding fuel to the bull case. The Army announced in July 2025 that it awarded Palantir an enterprise agreement that consolidates 75 contracts into one structure. The Army said the agreement is designed to speed delivery of data integration, analytics, and AI tools, and that the Army and other Defense Department agencies can buy Palantir products under the framework for up to 10 years, with a maximum potential value of $10 billion. The Army also made clear that the $10 billion is a ceiling, not a guaranteed commitment. That last part matters. Investors should not treat the full $10 billion as already booked revenue. It is not. But it still matters because it creates an easier buying lane. It reduces friction. It consolidates procurement. It gives Palantir a larger enterprise framework inside the Army and across other defense agencies. That is how government relationships deepen. Not always through one giant guaranteed check. Sometimes through frameworks that make future buying easier. Then came the USDA. Reuters reported on April 22 that the U.S. Department of Agriculture and Palantir signed a $300 million blanket purchase agreement. The agreement supports the National Farm Security Action Plan and the modernization of USDA service delivery, and it builds on Palantir's existing work with the USDA's landmark platform and the One Farmer, One File initiative. This is important because it shows Palantir expanding beyond pure defense. Defense is the headline, but government data modernization is the bigger landscape. If Palantir can become a standard operating layer across agencies, the story gets even larger. So the bull case is not hard to understand. The US government has messy data. The military has messy data. Large enterprises have messy data. Everybody wants AI. But AI is only as useful as the data and workflows behind it. That is Palantir's pitch. Do not just buy a chatbot. Build an operating system for your organization. Connect the data, control the permissions, create the workflow, put AI into the actual decision process. That is a powerful message. Especially in a world where everyone is trying to figure out which AI companies produce real business value and which ones only produce demos. Palantir's advantage is that it can say, we have been doing this for years. Before generative AI became the market's favorite phrase, Palantir was already working with complicated institutions, messy databases, security problems, and operational workflows. That history matters. The company is not trying to invent enterprise deployment from scratch. It is adding AI to a playbook it already had. That is why some investors see Palantir as one of the few software companies actually monetizing AI at scale. But this is also where the stock gets dangerous. Because the better the story gets, the more the market wants to price it today. Investors are not patient when they pay 40, 50, or 70 times sales. They are not saying, take your time. They are saying, prove it now. Every quarter becomes a test. Every guide becomes a referendum. Every slowdown becomes a question about whether the dream was too big. That is the risk. Not that Palantir is fake. The risk is that expectations become too high for even a strong company to clear. That brings us to the May 4th earnings setup. Palantir announced that its Q1 2026 results will be released on Monday, May 4th, after the U.S. market closes. With a webcast scheduled for 5 p.m. Eastern Time, this report matters more than a normal quarter. Because the market is not just waiting for revenue, it is waiting for confirmation. Confirmation that government momentum is still building. Confirmation that commercial demand is not slowing. Confirmation that AI platform adoption is still turning into real dollars. Confirmation that model companies are not taking the easy commercial spend away from Palantir. The headline, revenue number will matter. But I would watch US commercial revenue first. Why? Because the government story is getting clearer. Maven is moving deeper. The Army framework is in place. The USDA agreement adds another agency. The defense budget story is becoming easier to understand. But the commercial side is where the debate lives. That is where Burry's Anthropic warning hits. That is where investors will ask whether companies are choosing plug-and-play AI models instead of deeper Palantir deployments. That is where the premium multiple either gets oxygen or starts losing air. If US commercial revenue accelerates again, bulls can say the Anthropic threat is overstated. They can say Palantir is still winning the private sector. They can say the platform is not being displaced by models. But if US commercial comes in softer than expected, the whole conversation changes. Then the market may say the government story is strong, but the commercial story is not as explosive as the valuation needs. That is the danger zone. There are 4 numbers I would watch. First, U.S. commercial revenue. This is the heartbeat of the valuation. Government revenue is important, but U.S. commercial is where investors are looking for proof that Palantir can become a broad enterprise AI platform, not just a defense and intelligence giant. Second, customer count. If customer growth keeps expanding, it suggests Palantir is not just selling more to the same old base, it is bringing in new logos. That matters because one of the biggest questions around Palantir has always been whether the product can scale across many customers without requiring too much customization. Third, deal size. Big deals matter because Palantir wants to prove that once customers adopt the platform, they expand. Small pilots are nice. Large commitments are better. Fourth, guidance. At this valuation, guidance is not just a forecast, it is a confidence signal. If management raises full-year expectations, the market may breathe easier. If management only maintains guidance, that may still be objectively strong. But for a stock this expensive, objectively strong may not be enough. That is the brutal part. Palantir is at a level where investors may demand acceleration, not stability. They may demand upside, not just execution. They may demand proof that the AI wave is getting stronger, not just continuing. That is why this earnings report is so important. It is not just about the last quarter. It is about whether the market still believes the future is big enough. At this valuation, growth is oxygen. If oxygen keeps flowing, the stock can stay alive at a premium. If oxygen starts thinning, the multiple can compress fast. Now, let's talk about demand destruction. Usually, people use that phrase in commodities. Oil gets too expensive. Consumers drive less. Demand falls. But something similar can happen in valuation. AI demand may still be strong. Companies may still want automation. They may still want co-pilots. They may still want better analytics. They may still want AI agents inside workflows, but they may not want to pay Palantir-level pricing for every use case. That is the commercial risk. A customer might say, for mission-critical operations, we want Palantir, but for sales nodes, we use a lighter AI tool. For software development, we use Claude Code. For internal search, we use a cheaper model-based system. For customer service, we use a specialized AI vendor. In that world, Palantir still wins important work, but it does not win everything. And if the stock is priced as if Palantir captures a huge share of enterprise AI transformation, then even partial substitution matters. This is why Anthropic is such a useful comparison. Not because Anthropic replaces Maven tomorrow, that is not the point. The point is that Anthropic represents a different way for enterprises to consume AI faster, lighter, more model-native, more developer-friendly, potentially cheaper for some workflows. If that pattern spreads, Palantir may face pressure at the edges of commercial demand, not at the core defense layer, not in the hardest classified workflows, but at the easier commercial edge. And sometimes, the edge is where the market multiple lives, because the edge is where growth expectations are highest. This is why the debate around Palantir is so emotional. Bulls see a rare company. They see a business that sits at the intersection of AI defense, intelligence, data infrastructure, and enterprise transformation. They see a company with deep government relationships. They see massive commercial growth. They see high margins. They see cash flow. They see a product that may become extremely sticky, and honestly, they are not making that up. The bull case has real evidence. But bears see something else. They see a stock priced as if everything goes right. They see a company worth hundreds of billions of dollars with revenue that is still small compared with mega-cap software giants. They see model companies moving fast. They see investors treating every government headline like guaranteed future revenue. They see a valuation that leaves almost no margin for error. And honestly, they are not making that up either. The bear case also has real evidence. That is what makes PLTR so difficult. It is not a simple good company versus bad company debate. It is a great company versus extreme expectations debate. Those are very different. A bad company can collapse because the business is broken. A great company can fall because the price was too high. A bad company disappoints because it cannot execute. A great company can disappoint because it executes well, but not perfectly. That is the situation here. Palantir does not need to prove it is real. It already has. It needs to prove it is worth the valuation. And that is much harder. Because valuation is not just about what the company did yesterday, it is about how much future perfection investors already bought today. The government moat still deserves respect. Maven becoming a program of record would be a serious milestone. The Army agreement matters. The USDA agreement matters. The broader shift toward AI-enabled defense decision-making matters, and the Pentagon's interest in connecting battlefield data across domains matters. In that environment, Palantir is well positioned. It has experience, it has trust, it has security, credibility. It has a long history with government customers. It has already survived complicated deployment environments that is not easy to copy. A model company can ship a better model. A startup can build a beautiful interface. A cloud provider can offer infrastructure. But building trust inside classified government workflows is a different game. It takes time, it takes access, it takes clearances, it takes procurement knowledge. It takes the ability to work with old systems and new systems at the same time. That is Palantir's strength. But again, this does not mean the stock can only go up. A moat protects the business. It does not automatically protect the valuation. That distinction is critical. A company can have a deep moat and still be overpriced. A company can have strong contracts and still disappoint shareholders. A company can become strategically important and still experience a major drawdown. If growth expectations get too aggressive, that is the part many investors ignore. They fall in love with the moat, then they forget the price, but the market never forgets the price for long. Eventually, every story has to meet the numbers. For Palantir, that meeting is getting more intense every quarter. So what should investors actually watch after May 4th? Not slogans, not social media fights, not emotional arguments. Watch the chain. First, is government lock-in getting deeper? If Maven is moving toward formal program status, if the Army framework keeps converting into real orders, and if new agencies keep signing agreements, the government thesis gets stronger. Second, is U.S. commercial demand still accelerating? This is the key test against the Anthropic argument. If Palantir keeps adding customers and expanding revenue quickly, the market can say the platform story is alive. Third, is guidance moving higher? At this valuation, the company may need to keep raising expectations just to keep the stock stable. Fourth, is the market still willing to pay for perceived irreplaceability? That is the real multiple question. Palantir is not being valued like a normal software company. It is being valued like something the market believes may become essential. That is powerful. But it is also fragile, because perceived irreplaceability can fade. If customers hesitate, if model companies keep taking spend, if growth slows, if guidance becomes conservative, if government headlines fail to convert into recognized revenue, then the market may stop paying the same premium. That does not mean Palantir becomes a bad company. It means the stock moves from dream pricing to proof pricing, and that transition can be painful. This is the real setup, not bullish or bearish. Proof versus price. Opportunity versus expectations. Infrastructure story versus valuation risk. My view is that the $2.3 billion Maven headline is important, but it is not the whole story. It is a signal, a strong signal. It tells us the Pentagon may want Maven deeper in the system. It tells us Palantir's defense relevance is increasing. It tells us AI is moving from experimental military technology toward a more permanent command layer. But it does not answer the investment question by itself, because the investment question is not, does Palantir matter? It clearly matters. The question is, how much of that future is already in the stock? If PLTR were trading at a normal software multiple, this government momentum would be easier to celebrate. But it is not trading at a normal multiple. It is trading like the market already expects Palantir to become one of the dominant AI infrastructure companies of the next decade. That can happen. But it has to keep being proven, quarter after quarter. In the government business, in the commercial business, in margins, in cash flow, in guidance, in customer expansion, in deal size, in retention, in the ability to fight off model companies where it matters. That is a lot of pressure. And pressure changes how stocks trade. A low expectation stock can rise on decent results. A high expectation stock may fall on good results. PLTR is a high expectation stock. That means investors should not only ask what can go right, they should ask what has to go right. Because at this valuation, the answer is almost everything. So here is the cleanest way to frame Palantir right now. The company has a massive opportunity. The stock has very little room for ordinary execution. Maven may become a deeper part of U.S. military AI that supports the national infrastructure story. The Army agreement gives Palantir a larger defense buying framework that supports the long-term government budget story. The USDA agreement shows Palantir can expand into broader government modernization. That supports the agency platform story. The Q4 numbers show huge growth. That supports the AI monetization story. But Anthropic's growth shows model companies are not standing still. That supports the competitive risk story. Burry's warning shows investors are nervous about where enterprise AI profits will actually land. That supports the valuation risk story. And Palantir's valuation shows the market is already paying for something close to perfection. That supports the downside risk story. So the answer is not simple. PLTR is not just a hype stock, and it is not just a safe infrastructure stock either. It is both a powerful company and a dangerous stock. That is the whole point. If government lock-in deepens, commercial growth keeps exploding, and guidance keeps rising, the stock can hold its premium. Maybe it can even go higher. But if commercial growth cools, if customer expansion slows, or if guidance fails to excite, the market may ask a colder question. Not whether Palantir is important, but whether Palantir is important enough to deserve this price. And that is the final takeaway. Do not stare only at the $2.3 billion headline. Do not stare only at Michael Burry's one-liner. Do not stare only at the May 4th earnings date. Watch the full chain: government lock-in, commercial acceleration, model competition, customer growth, deal expansion, guidance, valuation, market psychology. That is the chain that decides how PLTR trades from here. Palantir may be entering a new phase. A phase where it is no longer seen as just an analytics company. A phase where it is increasingly viewed as a national AI platform. That is a huge opportunity. But the stock is already priced like investors believe much of that future is coming. So the burden of proof is heavy. And that is why this moment is so important. After May 4th, the market may not ask, is Palantir a good company? That answer is already obvious. The market may ask, is Palantir good enough to remain this expensive? That is a much harder question. And it is the question every PLTR investor has to respect. This is not investment advice. It is a breakdown of market logic. The market sees price. We should watch behavior. And right now, the behavior says Palantir has one of the most powerful AI stories in the market. But it also says the stock has almost no room for average results. That is the opportunity. And that is the warning.